Today's price action across the board reflects a classic year-end book squaring and the market's reaction to the latest FOMC minutes. 1. Current price action and technical landscape.
SP500. The index is currently in a consolidation phase after failing to sustain a breakout above the 6,940 level. We are seeing a minor mean reversion toward the 6,900 psychological support. The blue horizontal line on your chart, 6,894.49, acts as the immediate point of control, POC, for this session. DXY US Dollar Index. The dollar is attempting a technical recovery or a dead cat bounce after a heavy bearish year. This uptick in the DXY is creating immediate overhead pressure on bullion and limiting the upside for equities. XAUUSD, gold. We are witnessing a sharp retracement. After a historic rally, the drop from $4,550 to the $4,340 region is a textbook example of aggressive profit-taking as institutional desks close their books for the fiscal year. US 10Y, 10-year Treasury yield. Yields have softened to 4.124%. Usually, lower yields provide a tailwind for growth tech stocks, but the current tech cooling sentiment is neutralizing this correlation. 2. Intermarket correlations and risk sentiment. AUDJPY, the risk proxy. The decline in AUDJPY is a significant risk-off signal. Since the Japanese yen, JPY, is a primary funding currency for carry trades, and the Aussie, AUD, is a high-beta commodity currency, this downward move confirms a defensive posture among participants. FOMC minutes, hawkish tilt. The 9-3 split revealed today suggests that the Federal Reserve is becoming more cautious about further rate cuts. This hawkish divergence is the primary driver behind the S&P 500's inability to print new all-time highs, ATH, today. 3. SP500 Outlook and Strategic Insights. For a professional short-term trader, the focus should remain on liquidity pools and volatility contraction. Base case, mean reversion. Expect range-bound price action between 6,890 and 6,920. This is driven by window dressing, where fund managers adjust their holdings to present a stronger portfolio for annual reports, typically preventing a major sell-off before Jan 1st. Bearish trigger. A sustained H1 candle close below 6,894 could trigger a hunt for sell-side liquidity, SSL, down to the 6,850 level. This would be a healthy cleansing of late-cycle long positions. Bullish scenario, the 7K quest. If the 6,900 level holds through tomorrow's close, the path is cleared for a psychological test of the 7,000 mark in the first week of January. Summary. Today is characterized by exhaustion rather than reversal. The market is breathing after a massive run-up, and low holiday liquidity is amplifying these corrective moves. Make sure to like and subscribe for expert analysis and high probability outlooks on the S&P 500.